There is a question that has quietly circulated among hedge fund managers, prop trading firms, and Wall Street insiders for decades now, and it goes something like this. If you had to hire someone with zero financial background to become a trader, what kind of person would you choose? The answer more often than not is a poker player, not a mathematician, not an economist, not even a seasoned investor, a poker player. And the reason for this is not some quirky coincidence or a romantic idea that trading is just gambling dressed up in a suit. The reason runs far deeper than that, touching something fundamental about how elite decision making actually works under conditions of incomplete information, psychological pressure, and financial consequence. The overlap between world class poker and world class trading is not accidental. It is structural. It is built into the very nature of what both disciplines demand from the human mind. And once you understand that structure, you begin to see why so many of the best traders in the world either came from poker tables or wish they had. To understand why this connection exists, you first need to discard a myth that most people carry about trading. The myth is that great trading is about being right. People imagine the ideal trader as someone who sees the market clearly, makes accurate predictions, and profits from that accuracy. In reality, the best traders in the world are not the ones who are right the most often. They are the ones who manage being wrong in the most profitable way. This distinction sounds subtle, but it changes everything. A trader who is right 60% of the time but loses $10 on every bad trade for every $1 they make on good trades will go broke. A trader who is right only 40% of the time but manages their losses tightly and lets their winners run will compound wealth indefinitely. Trading is not a test of prediction accuracy. It is a test of decision quality under uncertainty, and that is precisely the game that poker players spend years, sometimes decades, mastering. Poker at its highest levels is not a gambling game in the way that most people understand gambling. Roulette is gambling. Slot machines are gambling. In those games, no amount of skill changes the underlying odds. Poker is different because the decisions you make directly affect your expected outcome over time. A skilled poker player does not win every hand. They win more money than they lose over thousands and thousands of hands by making better decisions than their opponents in moments of genuine uncertainty. They are not trying to know what card will come next. They are trying to calculate whether the potential reward of a situation justifies the risk of committing money to it, given everything they know and everything they do not know. That calculation, performed again and again under time pressure with money on the line and other human beings trying to deceive you, is functionally identical to what a great trader does every single day. Consider the concept of expected value. In poker, every decision can theoretically be reduced to an expected value calculation. You are holding a hand that might be the best hand or might not be. There is money already in the pot. You have to decide whether to bet, call, raise, or fold. The correct decision is not the one that wins this particular hand. The correct decision is the one that, if made repeatedly in the same situation, produces the most money over time. A player who folds a losing hand and a player who calls a winning hand might make the exact same decision quality depending on the information available at the time. Outcome does not determine decision quality. Expected value does. This concept, which poker players internalize through thousands of hours of repetition, is something that most retail traders never fully grasp. They judge their decisions by whether they made money on that particular trade. Professionals judge their decisions by whether the setup had positive expected value given what they knew when they entered. The best traders think in bets, and poker is the training ground for exactly that kind of thinking. Annie Duke, who was one of the top poker players in the world before becoming a decision-making consultant and author, wrote extensively about this distinction in her work. She described the challenge of separating the quality of a decision from the quality of the outcome as one of the hardest mental skills any decision maker can develop. She called the failure to do this resulting, and it is epidemic among traders. A trader who makes a brilliant decision based on sound analysis and then loses money on that trade because of an unexpected news event will often abandon the strategy entirely, even though the strategy was correct. Meanwhile, a trader who makes a reckless decision that happens to pay off will often double down on that recklessness, convinced they have found an edge. Poker players are forced to confront this problem constantly because the feedback loop in poker is compressed and repetitive. You play hundreds of hands in a session. You see over and over again that good decisions sometimes lose and bad decisions sometimes win. You are forced, if you want to survive in the game, to build a mental framework that evaluates your decisions independently of their outcomes. That framework is extraordinarily valuable in markets. The psychological dimension of this overlap goes even further. Markets are not just mathematical environments, they are human environments, which means they are environments saturated with emotion, narrative, fear, and greed. Prices move not just because of fundamentals, but because of how human beings feel about those fundamentals at any given moment. The great traders understand this because they understand people, and poker is perhaps the most concentrated school of human psychology that exists. At a poker table, you are constantly reading other players. You are watching how they bet when they are confident versus when they are uncertain. You are watching how they respond to pressure. You are watching for inconsistencies between how they present themselves and what their actions reveal. You are tracking your own internal states and trying to prevent them from leaking into your behavior. You are managing the emotional experience of losing, of being on tilt, of running bad for days in a row while continuing to make sound decisions. All of this is directly applicable to trading, where you need to read market sentiment, manage your own emotional reactions to losses, maintain discipline during drawdown periods, and resist the narrative seductions that markets constantly produce. The concept of tilt is worth pausing on because it is one of the most important psychological concepts in both poker and trading, and it is one that most people outside of those worlds do not have a clear name for. Tilt refers to the state in which a player's emotions have compromised their decision making. It typically happens after a bad beat, which is when you lose a hand you were favored to win. The emotional frustration of the bad beat spills over into subsequent decisions, causing the player to bet more aggressively, to try to win back losses, to play hands they should fold, to abandon their strategy in favor of emotional relief. In trading, this manifests as revenge trading, doubling down on losing positions, abandoning stop losses, making larger bets after losses to try to recover quickly. It is one of the primary reasons that traders blow up their accounts. Poker players have an entire culture and vocabulary built around recognizing and managing tilt because their financial survival depends on it. They develop pre-game rituals, post-bad beat protocols, and self-awareness practices that allow them to recognize when their decision-making is compromised and step back before they do serious damage. Traders who come from poker backgrounds often have this skill already developed. It is one of the most concrete and measurable advantages they carry into markets. The question of bankroll management is another area where poker and trading overlap with remarkable precision. In poker, bankroll management is the practice of only playing at stakes, where the total amount you might lose in a worst-case variance scenario represents a survivable fraction of your overall capital. A professional poker player might have 100 buy-ins for the stakes they play, not because they expect to lose all of them, but because they understand that variance is real and that even a great player can experience extended losing streaks through no fault of their own. Playing within your bankroll is not timidity. It is the mathematical foundation of long-term survival in the game. The equivalent in trading is position sizing, risk management, and drawdown limits. A trader who bets too large a fraction of their capital on any single trade, even if that trade has positive expected value, is playing with their survival in a way that the mathematics of compounding cannot sustain. The Kelly criterion, which is a formula used by both professional poker players and traders to determine optimal bet size, makes this precise. You bet not the maximum amount that your edge justifies, but the amount that maximizes your long-term growth rate while keeping ruin probability acceptably low. Poker players who have studied this extensively often arrive at trading with an intuitive grasp of position sizing that their non-poker peers lack entirely. There is also the matter of information processing under time pressure. In poker, you are constantly working with incomplete information. You can see your own cards and the community cards, but you cannot see your opponent's hands. Every bet your opponent makes is a signal, but an ambiguous one. They might be betting because they are strong. They might be betting because they want you to think they are strong when they are weak. The art of poker is developing the ability to synthesize all available signals, including bet sizing, timing, prior behavior, position, and table dynamics, into a probabilistic estimate of what is likely true, and then acting on that estimate decisively while remaining willing to update when new information arrives. This is exactly what a great trader does with price action, volume, order flow, news, and market structure. The trader who can process multiple streams of ambiguous information simultaneously, form a probabilistic view, act decisively, and update their view without ego when the evidence shifts is the trader who survives and thrives. Poker builds that exact cognitive muscle through repetition, feedback, and the very real consequence of financial loss when you get it wrong. Some of the most successful traders and fund managers in history have either been serious poker players themselves or have drawn explicit parallels between poker and their trading philosophy. David Einhorn, the founder of Greenlight Capital and one of the most respected value investors of his generation, is also a world-class tournament poker player who has finished in the top levels of the World Series of Poker. He has spoken openly about how poker sharpened his thinking about risk, uncertainty, and the management of his own psychology under pressure. Bill Perkins, a successful energy trader and hedge fund manager, is also a high-stakes recreational poker player who has explicitly described the connection between the two activities in terms of expected value thinking and emotional management. Many quantitative trading firms, including some of the most successful ones, have actively recruited from the poker community, recognizing that the cognitive skills developed at the table transfer cleanly to the trading floor. This is not a coincidence or a cultural quirk. It is a deliberate recognition that poker develops exactly the skills that trading demands. The role of patience in both disciplines is perhaps underappreciated in public discourse about trading, but it is absolutely central to elite performance in both. Poker is mostly waiting. A great poker player folds the vast majority of hands they are dealt. They wait for situations where their hand, their position, and their read of the table align to create a genuinely favorable situation, and then they apply maximum pressure. They resist the constant temptation to get involved in marginal spots out of boredom, the desire for action, or the emotional need to feel like they are playing. The same patience is required in trading. The best traders wait for their highest conviction setups. They do not trade constantly. They trade selectively, and when they trade, they commit with conviction. Jesse Livermore, one of the greatest speculators in Wall Street history, described this as sitting tight, which he considered the hardest and most profitable thing a trader could do. Ed Seykota, one of the legends profiled in Jack Schwager's Market Wizards series, described great trading as waiting for the right trade and then hitting it hard. This patience, this ability to remain inactive until the conditions are genuinely favorable, and then strike decisively, is something poker players learn through direct financial consequence. Every time you play a bad hand out of impatience, you lose money. The lesson is clear and immediate. The adversarial nature of both games is also worth examining closely. Markets are sometimes described as zero-sum in the short term, particularly in certain trading environments. Poker is explicitly zero-sum. Every chip that someone wins comes from someone else. This means that in both environments, you are not just competing against a mathematical problem. You are competing against other intelligent, adaptive human beings who are also trying to win, who are studying you just as you are studying them, and who will exploit any weakness or pattern you develop if given the opportunity. This adversarial dynamic breeds a particular kind of mental flexibility and intellectual humility. The poker player who develops a successful strategy cannot simply run that strategy on autopilot because their opponents will adapt. They must constantly think about what their opponents are thinking, what patterns their opponents have noticed in their play, and how to adjust. This metacognitive loop, thinking about how others are thinking about your thinking, is directly relevant to trading, where your edge can be competed away if you are not constantly evolving your approach. There is also something deeply useful in what poker teaches about the nature of edges and their fragility. In poker, edges are real, but they are always probabilistic, and they are always under competitive pressure. If a strategy becomes too widely known, it stops working because everyone adjusts against it. If you play the same way in every situation, sophisticated opponents will figure out your patterns and exploit them. The edge you have today is not guaranteed tomorrow. This is identical to the situation in markets. The academic literature on trading strategies is full of evidence that as soon as an edge becomes widely identified and published, it tends to disappear because market participants adjust. Strategies that worked in one market regime stop working when the regime changes. The trader who believes they have found a permanent, risk-free edge in the market is setting themselves up for catastrophic disappointment. Poker players carry a natural skepticism about permanent edges because they have seen strategies come and go, because they have experienced periods where everything seemed to work, followed by periods where nothing did, and because they understand at a visceral level that the market, like the poker table, is an adaptive environment that responds to your presence in it. Risk and uncertainty are two different things, and elite poker players understand this distinction with a precision that most people, including many traders, never develop. Risk refers to situations where the probabilities are known. Uncertainty refers to situations where the probabilities themselves are unknown. Most of the interesting decisions in life, in poker, and in markets fall into the category of uncertainty rather than risk. You do not know the exact probability that a stock will go up or down. You do not know the precise probability that your opponent is bluffing. You are operating under deep uncertainty, and the question is how to make good decisions in that environment. The answer that both poker and trading point toward is a combination of rigorous analysis of available information, honest acknowledgement of what you do not and cannot know, and the construction of asymmetric positions, where the potential upside if you are right significantly exceeds the potential downside if you are wrong. This principle, sometimes called the risk-reward ratio in trading and the pot odds concept in poker, is the mathematical backbone of making money under uncertainty. Poker players internalize it through repetition. Many traders never fully internalize it at all. The social and emotional intelligence developed at the poker table is also more valuable in markets than it might initially seem. Markets are not purely mechanical systems driven by cold data. They are, at their core, aggregations of human belief, human fear, and human hope. Prices represent what millions of human beings collectively believe something is worth at any given moment. And those beliefs are subject to all the cognitive biases, emotional swings, and narrative influences that human psychology is prone to. A trader who understands how crowds form and break, how narratives take hold and collapse, how fear and greed cycle through market participants, has an edge that no purely quantitative model can fully replicate. Poker players develop an intuitive understanding of human psychology, of how people behave under pressure, of how narratives and table dynamics shift, that translates naturally into reading market psychology. The great traders often describe a sense of being able to feel the market, to sense when a trend is exhausting itself, or when a narrative is becoming too crowded. That feeling, while difficult to quantify, is rooted in a deep pattern recognition about human behavior that poker develops over years of close observation. The capacity to handle variance, which is the statistical term for the natural swings that occur even when you are making correct decisions, is perhaps the most emotionally demanding skill in both poker and trading. Variance is real, it is unavoidable, and it is psychologically brutal. A great poker player can go on a losing streak for weeks or months despite making excellent decisions throughout, because the cards simply do not cooperate. A great trader can have an excellent strategy with positive expected value that still produces a string of losing trades, because the market moves in unpredictable short-term ways. The ability to endure this variance, to continue making sound decisions despite a run of bad outcomes, to trust your process when the results are not validating it, is one of the hardest psychological feats in any performance domain. Poker players are perhaps better prepared for this than almost any other group of professionals because they face compressed variance constantly, and they learn, through painful experience, that short-term results are often misleading indicators of decision quality. A poker player who quits their strategy after a losing month without examining whether their decisions were actually sound has failed to learn the deepest lesson the game offers. The same lesson applies with equal force to trading. The best poker players also develop an extraordinary relationship with money that turns out to be exactly the right relationship for trading. Most people have a complicated emotional relationship with money. They feel pain when they lose it that is disproportionate to the pleasure they feel when they gain it. Behavioral economists call this loss aversion, and it is one of the most powerful and well-documented biases in human psychology. For traders, loss aversion is catastrophically damaging because it causes them to cut winners too early, trying to lock in the good feeling of a profit, and hold losers too long, trying to avoid the bad feeling of realizing a loss. Poker players, who regularly push large sums of money into the pot and then watch it move to someone else, develop a more calibrated and pragmatic relationship with the money they are managing. They come to see chips not as money in the emotional sense, but as a tool for keeping score, as a resource to be deployed strategically rather than protected emotionally. The best traders develop an almost identical relationship with the capital in their accounts. They manage it as a professional manages any resource, with discipline and without the emotional attachment that leads to poor decisions. If you watch elite poker players in high-pressure situations, one of the things you notice is their ability to make decisions that are correct from a probability standpoint, even when those decisions feel uncomfortable or counterintuitive. They will fold what looks like a strong hand because the math of the situation tells them they are behind. They will make what looks like a bluff in a spot where bluffing seems crazy because the range of hands they should be bluffing with in that situation includes this specific hand. They trust the framework over the feeling. This is exactly what separates great traders from average ones. The great trader will take a trade that feels uncomfortable, that goes against the narrative everyone else is trading, because the analysis justifies it. They will cut a loss that feels premature because their risk management framework demands it. They will stay in a winning trade through uncomfortable volatility because their process says the trade is still valid. They act from principles rather than from feelings. And they have built those principles through enough repetition and reflection that they trust them even when the emotional environment is screaming for them to do something different. There is also the fundamental question of ego and its management, which both poker and trading force into the open in ways that most professions do not. In both environments, the feedback is direct, financial, and immediate. You cannot hide from the results. You cannot tell a story about how you would have done better if circumstances had been different. The money in your account either grows or shrinks, and your bankroll is a running score of your decision quality that you cannot manipulate through politics, charm, or narrative. This brutal objectivity is actually enormously valuable for development because it prevents the kind of self-deception that allows poor decision makers to survive indefinitely in many professions. But it also requires a particular kind of ego architecture to withstand. You need enough confidence to act decisively under uncertainty, to trust your analysis when the market is telling you something different, to hold a position through difficult periods when your conviction is genuine. But you need enough humility to update your views when the evidence genuinely shifts, to accept losses as a normal and expected part of the process, and to recognize that being wrong about a trade does not make you a bad trader any more than losing a hand makes you a bad poker player. This balance between confidence and humility, between conviction and flexibility, is the psychological sweet spot that elite performers in both domains occupy, and it is extraordinarily difficult to develop. The study of game theory, which is the mathematical framework for analyzing strategic decision-making among multiple agents, underlies much of advanced poker strategy and is increasingly central to quantitative trading as well. Game theory optimal play in poker refers to a strategy that cannot be exploited by opponents regardless of what they do, because it is built on mathematically sound principles about how often to value bet, how often to bluff, and how to construct ranges of hands that make your opponents indifferent between their options. The application of game theoretic thinking to markets is more complex, but the underlying logic is the same. Understanding not just what you think is true about an asset's value, but what other market participants think and how they are likely to respond to different information and price levels. Traders who think in game theoretic terms about market microstructure, about who is on the other side of their trades and what their incentives are, have a deeper understanding of how prices move than those who think about markets as purely objective phenomena. Perhaps the deepest connection between elite poker and elite trading lies in the philosophical orientation toward decision-making itself. Both disciplines, practiced at the highest level, demand what might be called probabilistic thinking as a way of life, not just as a technique to apply in specific situations, but as a fundamental orientation toward all decisions, all beliefs, and all outcomes. The probabilistic thinker does not say that something will happen or will not happen. They assign probabilities. They recognize that almost nothing is certain and that almost nothing is impossible. They update those probabilities as new information arrives. They make decisions not to guarantee outcomes, but to put themselves on the right side of the mathematical expectations as often as possible. They accept that good decisions will sometimes produce bad outcomes, and bad decisions will sometimes produce good outcomes. And they focus their energy on controlling the quality of their decision process, rather than trying to control outcomes that are ultimately not fully within their control. This is a profoundly mature and sophisticated relationship with reality, and it is one that most human beings, trained from childhood to think in terms of right and wrong, correct and incorrect, success and failure, find deeply counterintuitive. Poker forces you to develop this orientation because the game punishes you financially if you do not. Trading rewards it enormously when you do. The world's best traders are poker players, or think like poker players, because both pursuits demand the same rare combination of skills and orientations. They demand the ability to think in expected value rather than in outcomes. They demand the management of risk across a series of decisions rather than the optimization of any single decision. They demand the psychological resilience to withstand variance, losses, and uncertainty without losing either confidence or discipline. They demand a calibrated relationship with money that sees it as a tool rather than an emotional object. They demand patience, the willingness to wait for genuinely favorable situations, and resist the temptation to act when the conditions are not right. They demand intellectual honesty about what you know and what you do not know. They demand the ego flexibility to be both convicted and humble, to trust your process and update your beliefs simultaneously. And they demand, above all else, the ability to make good decisions in the absence of certainty, to act with incomplete information in real time under financial and psychological pressure, and to do so consistently, day after day, hand after hand, trade after trade, without the certainty of outcome that most human beings require to feel confident in what they are doing. If you can do all of that, you can make money in poker. If you can do all of that, you can make money in markets. And if you can find someone who has already learned to do all of that at a poker table, you have found someone who is very close to being a great trader, regardless of what they know about finance.